Hi, good morning, everyone. So today we're going to be discussing the exercises for Chapter 5 for accounting for merchandising operations. So taking a quick look back, basically last session, we talked about the definition of merchandising operations, the fundamentals of inventory system, and then we initially scanned what are the differences between perpetual and periodic inventory system. So for today's set of exercises, it's really all about mastery about how do you account for merchandising operations. And therefore, we can proceed in terms of our exercises breakdown. So actually, medyo marami tayong i-discuss. But as you can see, it's really a lot of concepts to digest. And therefore, it's very important for us to make sure that we master all of the journal entries, all of the concepts related in terms for deep dive with inventory and accounting for merchandising operations. So just a quick review. So again, we started our lesson with defining ano nga ba yung merchandising company. And in order to do this, we actually took a look at the three different types of companies. So service company, manufacturing company, and then merchandising company. And ultimately, what we said is that what sets merchandising companies apart is that they buy and sell goods or what we call merchandise. So basically, they do a buy and sell. And these merchandises are what we call inventory. So kindly take note, there are two types, your wholesalers and your retailers. So si wholesalers sell to other retailers, so B2B, and then si retailers sell directly to consumer or B2C. So in terms of their operating cycle, as you can see, it's just basically the whole 9 steps that we have to master revolves around this cycle, wherein number one, it's really all about purchasing inventory. So definitely when you buy inventory, it will be delivered to you. And then when it gets delivered to you, that's when it becomes an inventory, right? So basically you have inventory and then you sell it and then you receive cash, be it from a credit or a cash transaction. And then ultimately using that cash, you buy another set of inventory and it repeats and it repeats and it repeats. And that's ultimately the operating cycle of a merchandising operation. So now that we're clear, basically we took a deep dive in terms of the fundamentals of every inventory system. And we went into the formal definition of inventory. So basically, in terms of inventory, there are a lot of definitions. So either it's held for sale in the ordinary course of business or finished goods, process of production for such sale or work in process, and then form of materials or supplies to be consumed or raw materials in terms of the rendering. Aside from this, we identified that the major differences would be how merchandising operations actually categorize their expenses. We found out that unlike service companies, they actually have two major categories. So their cost of goods sold and operating expenses. And therefore, in terms of our accounting equation, particularly for net income, wherein revenue minus expense is equal to net income or net loss, nilagyan lang natin ng two other iterations. The first iteration is basically breaking down our expense through COGS and OPEX. So revenue minus COGS minus OPEX is equal to your net income or loss. And then the second iteration is matching our revenue and COGS because that's the reason for the categorization. That we categorize cost of goods sold because we match it alongside the related revenue. And therefore, revenue minus cost of goods sold, when you match them, gives you your gross profit. And ultimately, gross profit minus OPEX would be your net income or net loss. So in turn, we came up with this table wherein this is your comprehensive income statement in order to arrive with your net income and loss. And then ultimately, we also took a look at the cost flows. And in terms of cost flows, the two important things that we want to look at would be the quantity of the products and the cost of products. Wherein we saw that in terms of the operating cycle, every period you'll have your beginning inventory, and then when you add your new purchases for the period, you'll have for the month or for the period your cost of goods available for sale, which is very important because there's only two things that happen to our cost of goods available for sale. Either A, nabenta sila and therefore a portion of it will be recognized as cost of goods sold, or B, they're not sold and therefore they will retain itself as ending inventory, which will then be the beginning inventory for the next period. So now that we're clear with the concept, the very first thing that we have to master is the comprehensive income statement. So in 5.1, basically, there's a fill in the blanks wherein there are missing portions of the component. And like what I mentioned, every time we give you an equation, you have to be able to solve for the missing, right? It's actually very straightforward. So you have your missing accounts and let's try to solve for them. So number one, in order to get your COGS, it's just basically 75,000 minus 30,000, right? Equals to 45,000. And then for your OPEX, it's just basically gross profit minus your net income of 10,800 will give you your 19,200. So for the second set, basically gross profit naman yung wala. So to get gross profit, it's just sales revenue of 108,000 minus 70,000, which is equal to 38,000. And now that we have your gross profit, we know already how to solve for OPEX. 38,000 minus 29,500 will give you 8,500. And then finally, for the last set, si sales revenue naman yung wala. Therefore, since we know that the gross profit is 79,600 and we subtracted 83,900 from the sales revenue, we add these two together in order to arrive with 163,500 for sales revenue. And then ultimately for net income and net loss, it's just gross profit minus operating expenses to give us 40,100. So ayun, very straightforward and very clear, right? So now that we're familiar with this type of comprehensive income statement, the next thing that we have to master would definitely be the perpetual and periodic inventory system. And then again, kindly take note of their differences. So perpetual, you only recognize your cost of goods sold each time a sale occurs because it perpetually updates. On the other hand, periodic, since it's periodic, you only determine your COGS periodically or only determine at the end of the period, right? So kindly take note that for perpetual, it provides better control but also very costly. Perfect for high unit values. For periodic, these are for people that find it unnecessary or uneconomical to invest. So therefore, the very thing that I really want everyone to understand is that regardless if it's perpetual or periodic, it will have the same 9 concepts that you have to master. 4 concepts under purchase-related transactions, 3 concepts related to sales transactions, and 2 concepts which would be your adjusting and closing entries for our inventory systems. So first, let's master our sales journal entry. So we really made sure not to do it chronologically because sometimes you purchase and then you sell. So there's no 1 to 9 order. And you really have to master each 9 concepts and then apply it as, as the transactions come in. Right? So for this, let's master the sales journal entry. So for 5.3, basically we're talking about Daryl Company's books that uses perpetual inventory system. And when you look at the transactions given, out of the 9 concepts, they're mainly talking about 5, 6, and 7, which are sales-related transactions, right? So let's focus on these 3. So on March 2, Daryl Company sold 900,000 with the following terms, 210 and 30. So how do we journalize for this? Basically, we have 2 journal entries every time a sale occurs under perpetual. First is you recognize your sale with a debit AR credit sales revenue of 900,000. And then you also need to recognize the relevant COGS, which is 620,000 by debiting cost of goods sold, credit inventory 620,000. So that's for every sales transaction, right? Next, one company actually returned 90,000 of merchandise. Therefore, when you return under perpetual, that means that it would decrease your revenue that you had to recognize. And also, it decreases also the corresponding COGS that we initially matched, right? And therefore, number 1, we reverse the revenue recognized of 90,000. So debit sales return allowance, credit AR of 90. And then we also reverse a portion of the COGS recognized. So inventory, debit inventory, credit COGS of 62,000. because that's the cost of the merchandise returned. Now, very important that we have a special account called sales return and allowance, which would be your contra revenue account. So again, never debit sales revenue for merchandise returns or sales returns. You put sales return and allowance, right? And then the last is a payment. And every time there's a payment, be it a sales discount or purchase discount, the very first thing you ask yourself is it within the terms? Are we going to be availing for the discount? So let's look. So the terms is 210. So what are the relevant dates? March 2 and March 12. So 3, 4, 5, 6, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So sakto, 10 days. Therefore, you will avail of your sales discount. So again, memorize that the compound journal entry for sales discount is debit cash, debit, sales discount, credit AR. So now we need to find the values. And for discount, ang pinakamadaling unahin would be our accounts receivable. So let's solve for our outstanding receivable. So we get our invoice price of 90,000 and then subtract our sum of the portion of this because some of them were returned. So we get an outstanding of 810,000, which would represent our accounts receivable. Now, we pay the 800,000 pero discounted siya. So we solve the 2% discount on 810. We get 16,200. So we know na 16,200 to. Then finally, we squeeze for cash. So 810 minus 16.2 is 793,800 yung cash na you paid to settle for the 810. Now, let's try to use the same problem pero periodic, right? Gawin natin periodic. What if periodic siya? So here, we're focusing on sales transaction. And again, the only difference between perpetual and periodic is perpetual recognized COGS at every point of sale. And therefore, it has relevant entries like cost of goods sold inventory for sale and also reversing it pag may returns. Periodic, however, only computes for your cost of goods sold at the end of the period. Therefore, the only difference between sales transactions sa perpetual and periodic is that wala tong dalawang additional entries for sales of inventory and sales of return and allowance. And this is again because perpetual records COGS every time an inventory is sold, while periodic computes at the end of the period. So now, let's turn this into perpetual, right? So, madali lang. For this, same to, pero tatanggalin natin si COGS. For sales return and allowance, again, same entry. However, tatanggalin natin si COGS because they only solve for COGS at the end of the period. Then finally, for discount taken, it's also the same. So again, madali lang yung differences between perpetual and periodic. Kapag sales transactions, si perpetual, merong extra journal entries to recognize COGS, be it for a sale or reversing it kapag may sales return and allowance, right? So now, we've actually solved 5.3, right? So now that we've mastered sales transactions, the next thing that we need to master would be purchase-related journal entries, right? So now we move on to 5.2. And similarly, for 5.2, the transactions are focusing on the purchase-related transactions. So concepts 1 to 4, right? So let's take a look at each of the transactions, right? So basically, you have 5 transactions. So one transaction is all about buying equipment, pero the other 4 is all about inventory. So now, under perpetual system, what would be, how do we record purchases, right? Basically, we just debit inventory, credit accounts payable of 23,000, right? Next, there is freight. So it said the company paid for freight. And if we pay for freight, then we know that it's probably FOB shipping. If FOB shipping, we create a journal entry, which would be debit inventory, credit cash of 900, right? And then on April 7, we have an equipment. We bought an equipment, and therefore it's debit equipment, credit AP of 26,000, right? For number 3, basically it's all about purchase returns. So our journal entry for this would be debit accounts payable, credit inventory for the 3,000 of the merchandise sold. And then finally, again, this is a purchase discount question wherein we paid for in full. So again, we ask ourselves, pasok ba in terms of the terms. 210, what are the relevant dates? April 5 and April 15. 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 10 days. So pasok, we avail of the discount. So again, we write down the purchase discount entry, which would be debit accounts payable, credit cash, credit inventory. Now, in terms of the value, ang uunahin natin i-solve is the outstanding accounts payable. So we get the invoice price, the related inventory, the reduction of accounts payable because of the purchase return of 3,000. And then we get 20,000 in terms of our balance. So we know that the accounts payable is 20,000. Next, we solve for the discount. And the discount will be named inventory, right? So the discount is 20,000 times 2%, 400. So 400. And therefore, we squeeze in cash to get 19,600. So kindly take note, now when you're solving for discount, it only refers to the accounts payable that is related to that certain transaction. So meaning si cruise company, right? Si cruise company. Even though I have an accounts payable here, this is in relation to the equipment. So hindi siya related in the transaction. So huwag kayong malilito in terms of tracking for your accounts payable, right? So let's go to iteration 2. What if hindi raw tinake yung discount? Like they paid May 5, which is 30 days. Basically, mas madali yung journal entry natin. We still debit the accounts payable, but we pay in full. So cash 20,000. There is no reduction in inventory of 400 to represent our purchase discount, right? So again, similarly with what we did in the previous exercise, let's try to solve this for periodic, right? So for periodic, basically, the difference would be in periodic, we basically have temporary inventory accounts. Yung purchases, freight in, PRA, PD. So basically, walang inventory account under perpetual until the very end, right? So initially, sa purchase-related transactions, walang inventory the name initially, right? Therefore, the difference lang is, kung ito inventory lahat, ito purchases, freight in, PRA, PD, right? So applying this to 5.2, gawin natin siyang periodic. So in journal entry 1, purchase, the only difference is si inventory gagawin natin purchases, right? For journal entry 2, for FOB shipping, si inventory gagawin natin freight in. For journal number 3, si inventory na credit gagawin natin PRA or purchase return and allowance. And si 4.B, yung inventory na discount gagawin natin purchase discount. And basically, that's the difference, right? Same journal entry, same values, different account names lang. Walang inventory initially si periodic. Meron siyang purchases, freight in, credit of purchase return allowance, and credit of purchase discount, right? So that ends our 5.2. So finally, we go into our last theory, or what are the last concepts, which would be your closing journal entries. So for this, every time an inventory system will close, they will conduct a physical count, right? So we have to adjust for that physical count, right? So si Hugo refers to 8 and 9. So adjusting for the physical count and then ultimately closing our accounts, right? So here, we first ask ourselves, what is the inventory based on physical count? And that is 13,900. Now, we compare this, ano nga ba yung inventory based on the books or based on the records? According to the problem, it's 15,000. So the question is, ano yung susundan natin? The physical count. We always follow the physical count. Therefore, it should be 13,900. And therefore, the 15,000 should be decreased by 1,100. And therefore, our adjusting entry would be debit COGS of 1,100, credit inventory of 1,000. So again, learning for our quiz, every time you make an adjusting entry, you create or you reflect the adjustments. So now, let's try to adjust the cost of goods sold. Based on the given, it was 60,000. 60,000, 60,000. Since we debited COGS, this would be an increase of 1,100. And therefore, your adjusted COGS would be 61,100. Okay, versus the initial na 60,000. Now that we've updated COGS and now that we've accounted for the correct physical count, The next step is to close the entries, right? So after 8, gagawin na natin yung 9. So again, increase inventory and decrease inventory, it just kindly make sure you master the difference. But we always follow the physical count. So now we're ready to close. So step 1, we close the revenue accounts. So that would be debit sales revenue and then credit your sales return allowance and your sales discount. And then you squeeze in your income summary of 112,100. Next, you close your expense accounts, which would be debit income summary of 90,100, comprised of two things. One credit of COGS, 61,100, the updated or adjusted amount, right? And then the OPEX of 29,000. And then finally, pagbabanggain natin si income summary to eventually close it at a debit of income summary credit owner's capital of 22,000, right? So now, kindly make sure that you master your closing entries. And these are the closing entries for your perpetual, right? Kindly take note that we'll also discuss in the next lecture in focusing on the closing entries for periodic, right? So we're done na rin with 5.7. The last technicality here is, what if there's freight out? So let's see the difference. So in 5.8, again, we adjust muna for the physical count and then we close, right? So let's first adjust. What's the physical count? 21,600. What is the inventory on record? 21,000. So we follow the physical count. So we have to increase by 600. So now our journal entry would be debit inventory and then credit COGS now. So it's a reduction of your COGS of 600. And therefore, since we adjusted, let's make sure to adjust the given. The COGS that was given was 218,000. Since it's a debit, we have to subtract 600, giving us an adjusted cost of goods sold of 217,400. Now that we have this adjustment, we then close. So close revenue accounts. So again, debit sales revenue, credit SRA, credit SD. So you squeeze to find your income summary of a credit of 357,000. Next, we close our expense accounts. So debit income summary of the total credits. Cost of goods sold, 217,400, the adjusted amount. Freight out is an expense, so 7,000. And then your insurance, rent, and salaries from 12,000 to 55,000. If you total all of these, it would be a debit of income summary of 311,400. And then finally, we basically close the income summary. So pagbabanggain natin itong dalawa, to have a net income or a debit of income summary of 45,600, close to our owner's capital to 45,600, right? So actually, we're quickly done by mastering both our 9 concepts, right? From purchases to sales to always adjusting and closing, right? So now, as usual, now that we're done with the whole cycle, let's talk about the forms of the statement of comprehensive income. And honestly, the thing that you have to remember is that there are 2 approaches and that there are 2 forms of presentation. So in the approaches, we have the single statement and the 2 statement. So as the name suggests, a single statement, you have this header, and then straightforward in one statement, revenue less expense is equal to your profit or loss. And then you have your other comprehensive income items, and then you have your total comprehensive income. Now, in contrast, in the 2-statement approach, we have the first statement. So 2 statements. The first statement being the income statement. So that's revenue less expenses is equal to your profit and loss. And then the second statement will be named your statement of comprehensive income. So yung profit or loss mo, dadalhin mo here, and then you add your other comprehensive, and then you get your total comprehensive income. So again, regardless kung single statement or double statement, it will still give you the same total comprehensive income na iba lang yung presentation. And then, in terms of the forms of presentation, you can categorize your expenses based on the nature or the function. So sa nature of expenses, it's very straightforward. Revenues minus expenses is profit or loss. Compared to the function of expenses, wherein it's broken down per function. So you first get your sales revenue, and then you deduct your SRA and your sales discount to get your net sales. And then you subtract your cost of goods sold, the first category of expenses, to get your gross profit. And then you add your second types of revenues or your other income, so your interest and your rent, your other expenses in the form of selling and administrative expenses, and then your finance cost. So you total this to get your profit or loss. So in the function of expenses, it's important to understand also how to get your gross profit rate, which is basically gross profit divided by net sales. And then it will just give you a percentage of how much your gross profit is based on your net sales, right? So just imagine if your net sales will always be the biggest amount. So if you have 1,000 net sales, you'll have a portion of that will be cost of goods sold, a portion of that yung tubo mo or your gross profit. So in this example, your gross profit is 300. Therefore, 300 divided by 1,000 is 30%. So 30% of net sales is gross profit. 70% of it would be your cost of goods, right? So in essence, maraming forms, maraming approaches, but the most usual that we apply would be this multi-step, right? That first, we calculate our gross profit. And then from there, we calculate our income from operations. And then we subtract other expenses and loss so that we can get our comprehensive income of 31,600, right? So now that we're clear, let's make our financial statement. So in 5.9, basically, it wants you to create your multi-step income statement. So basically, we start with the header, charge company, income statement for the month ended March. And then what are the different components? First, we get sales, and then we try to get net sales by subtracting SRA and sales discount. Then from there, we get our cost of goods sold. And then ultimately, we want to the very first thing that we want to solve for would be our gross profit. After our gross profit, we look at our operating expenses, get the total, subtract total OPEX from gross profit to arrive with our net income. So basically, now that we're clear with the format, it's just basically filling in the blanks, right? So first, sales is 380,000. Then we subtract our sales return allowance of 13,000. We subtract our sales discount of 8,000 to give us a net sales of 359,000 because 380 minus 21,000 is 359, right? Next, we get our cost of goods sold, which is 212. So that we can get 359 minus 212 will be 147,000 gross profit. Then the last would be recognizing our operating expenses based on how big the expense is. So we start with salaries, wages, and expense. Then the rent. Then freight out, and then insurance. And then if you total this, it's 103,000. So that finally we can solve for our gross profit. Our gross profit minus our total OPEX would be 147,000 minus 103,000 would be a net income of 44,000. So now that we're done with the analysis, we basically solve naman for gross profit rate, right? Which is just gross profit over net sales. So basically, we get 40.95%, meaning 40.95% of net sales would be your gross profit. Roughly 41%. So meaning you can anticipate that 59% would be your cost of goods sold, right? So we're done with 5.9. And then finally, let's master the IS or the multiple step income statement, right? So again, meron na namang missing. But again, don't worry, you just create the table. Then from there, it's easy to find the missing. For A, it's the sales return allowance. So from 90, naging 86. And therefore, we can deduct na this is minus 4,000. Now that we have our net sales, we can get our gross profit of 86 minus 56, 30,000. And then less OPEX, we'll get our income from operations. So 30 minus 15 is 15,000. And then we get our net income, which is 15,000 minus 4,000, which is 11,000, right? For E, sales revenue is missing. We know that the net sales 95, and then previously we deducted 5,000. So we add both of them together to get the sales revenue of 100,000. And then now that we know our net sales and our gross profit, we can identify that the cost of goods sold would probably be 95 minus 38 is 57,000. And then here, dito yung medyo mahirap na part. We can't solve for OPEX yet, but what we can solve is for income for operations of 18,000, which is basically net income of 11,000 plus the 7,000 other expense losses so that we can get our income from operations. Now that we have our income from operations, 38 minus 18 will give us the operating expense of 20,000. So finally, we get our net sales for this particular question. So 122 minus 12, 110. 110 minus 24 would give you your cost of goods sold of 86. Then income from our operations is just 24,000 gross profit minus operating expense of 18,000, which is 6,000. And then given that we know that the net income is 5,000, then there's probably a deduction of 1,000 pesos, which was 6,000 minus 5,000. So again, very straightforward. Just make sure you master the comprehensive income statement. So the next question that we ask is, what if there are errors? So 5.11 discusses kung merong errors. And again, for correcting entries, we just have to follow the what is, what should be framework. So here, what is, basically, they made an entry of debit sales revenue, credit cash, when in fact, what they should have done was use sales return allowance as a debit. Therefore, our correcting entry is just very straightforward, which is debit your sales return allowance and then credit your sales revenue, which was the incorrect account, right? So this would be your correcting entry. So now, this is the perpetual correcting entry. The question is, may pagkakaiba ba if it was periodic? The answer is no. Because they use the same accounts for sales-related transactions, right? For the second error, basically, they create debited inventory credit cash of 180, when in fact, it should be a debit supplies credit accounts payable of 180. So here, it's just very simple. We reverse the wrong entry. So therefore, that would mean credit inventory of 180, debit cash 180, and then we just write the correct entry, which is debit supplies of 180, credit accounts payable of 180 in this compound journal entry. Again, this is our perpetual correcting entry. Is there a difference in periodic? The answer is no, right? Because this inventory is a previous mistake, and then it should have been really supplies, right? Error number 3. Yung sales discount, they erroneously debited it to sales revenue. So in fact, the should be would be debit sales discount, credit cash of 215. So similarly, we just correct this. Debit sales discount, credit sales revenue of 215. Again, this is our perpetual correcting entry. Will there be a difference if it's periodic? No. Right? Because sales-related transactions, ang difference lang nila is that walang COGS na nire-recognize si periodic during sales. It's only at the end of the period. So now we're at the end portion or the last error. So cash payment of 20. So basically, they debited freight out in credited cash for 200. Now, the correct entry should have been debit inventory for 20 lang. Credit cash. And therefore, to correct this, we debit inventory of 20, credit cash of 180 because right now we subtracted cash of 200 when in fact it should have been a deduction of 20 only. So we debit back 180 and then we derecognize this wrong freight out account. So credit freight out of 200. So this is our perpetual. Now, is there a change? Yes, finally there is a change. Again, we don't use inventory in the initial purchase transaction. Instead, we use freight in of 20, right? So kindly take note of the difference. But these are our correcting entries. So finally, for our last exercises, let's put everything together in this comprehensive problem under Jeremy's book Warehouse, right? So under Jeremy's book Warehouse, they actually touch upon a lot of the concepts already. So let's take it day per day rather than concept per concept, right? So on June 1, basically they purchase books, right? And under perpetual, this is just gonna be debit inventory, credit accounts payable 1,600. there is no freight in entry because it's FOB destination. So pag FOB destination and we're the buyer, we don't pay for the freight cost and therefore the recording should be on the seller side. So si seller yon, which is freight out, debit, credit, cash of 50. But that's on the seller side, right? On June 3, we sold books. So pag perpetual, we expect two entries. One to recognize revenue, debit AR, credit sales of 25, and then one to recognize the matching COGS, which is debit COGS, credit inventory, 1,440. On June 6, there was a return from the purchase. So therefore, we debit AP, credit inventory of 100. And then finally, we paid for the purchases. Now the question is there a discount? So again, we look at the terms, 210. The relevant dates would be June 1 and June 9. So 2, 3, 4, 5, 6, 7, 8, 9. So 8 days. Therefore, we availed of the discount. So we know that the entry here should be debit AP, credit cash, credit inventory. Let's first solve for the AP. The outstanding would be 1,600 less the return of 100, which is 1,500. So we have an accounts payable of debit of 1,500. Then we get the 2% discount, which is 30. So now we plug it in here. And then we squeeze the cash of 1,407. Right? So these are the 4 transactions for the 4 first transactions. Moving on to the next 4. In June 15, they received payment in full. So again, from the sale naman. So now we ask ourselves, what are the terms? 210, and then the relevant dates are June 3, June 15. 3, so 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 12 days have passed. There is no discount, and therefore, we just debit cash, credit accounts receivable of 2,500. Kasi 2,500 natin siya nabenta. Accounts receivables, 2,500. So 2,500. In June 17, we sold books on account. So again, we sold books. So 2 entries na naman. Revenue, debit AR, credit sales revenue of 1,800. Match the COGS. Debit COGS, credit inventory, 1,080. Right? In June 20, they purchased again to replenish their stock. So that's just basically debit inventory, credit AP. Again, FOB destination. So walang entry to record any freight. Right? Wala. And then on June 24, received payment in full for Lapidus. So what are the terms? 210. The dates are June 17, June 24. So that's 7 days. So there is a sales discount. So debit cash, credit sales debit cash, debit sales discount, credit accounts receivable. So now let's solve for the outstanding accounts receivable. So that's 1,800. Then walang returns or allowance, so 1,800. Now we get a 2% discount, so 36. So this is 36, and then we plug in or squeeze our cash of 1,764. Finally, the last 3 entries would be they paid the publisher, so they bought from the purchase. So again, what are the terms? 210. What are the relevant dates? June 20 and June 26. So that's 6 days. So pasok. So now we know that there's a purchase discount. So debit accounts payable, credit cash, credit inventory. So the invoice price 1,500. May returns ba? Wala. So the balance is 1,500 for accounts payable. But then in terms of the cash we have to pay, there's actually a sale purchase discount of 30. Therefore, our cash would be squeezed to 1,470. Finally, we sold another round of books. So debit AR, credit sales revenue of 1,400, match the COGS, debit COGS, credit inventory of 850. Then we granted a credit, and therefore we have to derecognize a portion of the sale and derecognize a portion of the COGS. So here we use sales return allowance, which is a contra revenue account of 120 as a debit, and then credit AR of 120. And then we also lower the COGS, so debit inventory COGS of 72. So actually that finishes the whole comprehensive transaction for this solution. Now let's turn this to inventory. para one last time we master the differences. So for periodic, journal entry 1, pag purchase, ang mag-iiba lang is the account name, right? So itong inventory na to will be purchases. 5.1 is a sales. So it's same. And therefore, we don't recognize this COGS because we do it at the end of the period. Journal entry is PRA. So ibay natin sa inventory 2, purchase returns and allowance. C4.B, discount. So ibay natin sa inventory 2, purchase discount. For this journal entry, paano natin gagawing periodic? Actually, it's the same because this is a sales discount not taken. This is a sale. So again, same yung initial entry, but then we don't recognize the COGS. Again, it's not inventory, but it's purchases. And then finally, for the discount, since it's sales discount, pareho lang sila, right? And then for our last 3 entries, we have the purchase discount. So again, under perpetual, wala tayong inventory here. It should be purchase discount. For this one, sale, again, it's the same, pero tatanggalin natin si COGS. And for sales return and allowance, same, pero tatanggalin natin si COGS because we only record at the end. And actually, that officially ends all of our exercises for inventory system basics. So thank you so much, everyone.